something wild most people don't know. In 2008, when the S&P 500 absolutely tanked, dropping 37% and wiping out trillions in wealth, there were specific investments that actually went up. Not just survived, not just broke even. They literally gained 20, 30, even 40% while everyone else was panicking. And here's the crazy part. This isn't a secret strategy. These are investments anyone can access right now. And by the end of this video, you're going to know exactly which 7 assets to hold when the next recession hits, because it's not a matter of if, it's a matter of when. I spent the last few months analyzing multiple recessions, market crashes, and economic downturns to figure out what actually works when everything falls apart. And what I found completely changed how I think about building wealth. So let's dive in. Look, I know nobody wants to think about recessions. It's kind of like thinking about your car breaking down. You know it'll happen eventually, but you don't want to dwell on it. But here's the thing. Economic cycles are inevitable. They've happened every 5 to 10 years for the past century. The Great Recession, the dot-com crash, the COVID crash, the '87 crash, they just keep coming. And right now, most people's portfolios are set up to absolutely get destroyed when the next one hits. They're heavily weighted in growth stocks, tech, speculative assets, all the stuff that gets crushed first when fear takes over. But, and this is the important part, there are 7 specific types of investments that have proven, across multiple recessions, that they not only survive chaos, they thrive in it. So let me show you exactly what they are, why they work, and how you can actually start investing in them today. Let's get into it. All right, first up, consumer staples. And I know, this sounds boring. But boring is beautiful during a recession. Consumer staples are companies that sell stuff people need. We're talking toilet paper, toothpaste, food, cleaning supplies. The stuff you buy whether the economy's booming or crashing. Think about it. When the stock market tanks and everyone's freaking out, are you going to stop buying groceries? No. Are you going to stop buying soap? Obviously not. During the 2008 financial crisis, while the overall market dropped 37%, companies like Walmart actually gained 20%. Procter & Gamble, the company that makes Tide and Pampers, barely dropped at all. Costco held strong. The reason is simple. Demand doesn't disappear during recessions for these products. People might stop buying new iPhones. They might delay vacations, but they're still brushing their teeth. So how do you invest? You can buy individual stocks like Procter & Gamble, Coca-Cola, or Walmart. Or, easier option, grab an ETF like VDC or XLP that holds a basket of consumer staple companies. I personally keep about 15 to 20% of my defensive allocation in consumer staples. It's not sexy, but it works. Next up, Dividend Aristocrats. And if you haven't heard this term, it's about to become your new best friend. A dividend aristocrat is a company that's increased its dividend payment every single year for at least 25 consecutive years. We're talking companies like Johnson & Johnson, Coca-Cola, 3M, McDonald's. Now, why does this matter during a recession? 2 reasons. First, these companies are proven survivors. You don't increase dividends for 25 plus years by being fragile. These are businesses with rock-solid fundamentals, strong cash flow, and competitive moats. Second, they pay you to hold them. When your tech stocks are down 50% and paying you nothing, your dividend aristocrats are depositing cash in your account every quarter. During 2008, while growth stocks got demolished, many dividend aristocrats held up remarkably well. And even if their stock price dipped temporarily, they kept paying dividends, which you could then reinvest at lower prices. It's like getting paid to wait for the recovery. And psychologically, that cash flow makes it way easier to not panic sell when things get ugly. You can invest directly in Dividend Aristocrats through the NOBL ETF, or build your own portfolio of these stocks. I keep about 20 to 25% of my portfolio in dividend-paying stocks, specifically for this reason. All right, number 3. And this one's been working for literally thousands of years. Gold and precious metals. Now, I can already hear some of you saying, "Ugh, gold? Really? That's so old school." And look, I get it. Gold doesn't pay dividends. It doesn't generate cash flow. It just sits there, being shiny. But here's the thing. Gold is the ultimate hedge against uncertainty. When currencies wobble, when governments print money, when inflation spikes, when markets crash, gold tends to do well. It's been that way for 3,000 years. In 2008, while stocks crashed, gold went up 5.5%. In 2011, during the European debt crisis, gold hit all-time highs. During the COVID crash in 2020, gold surged to record levels. The reason is simple. When people panic, they run to safety. And for better or worse, gold has been viewed as safe throughout human history. It's like financial insurance. Now, I'm not saying go all in on gold. That's crazy. But having 5 to 10% of your portfolio in gold or precious metals, that's a smart hedge. You can buy physical gold, coins, bars. You can buy gold ETFs like GLD or IAU. You can buy mining stocks, or you can buy funds that hold a basket of precious metals. I personally keep about 5 to 7% in gold through a combination of ETFs and some physical holdings. It's my sleep well at night insurance policy. Number 4, and this is where the smart money runs during panic. Long-term Treasury bonds. Okay, so Treasury bonds are basically loans you make to the U.S. government. You buy a bond, the government pays you interest, and eventually gives you your money back. Sounds boring, right? But during recessions, they're absolute gold. Here's what happens. When a recession hits and markets crash, the Federal Reserve typically cuts interest rates to stimulate the economy. When rates drop, existing bonds that pay higher rates become more valuable. Think of it this way. If you own a bond paying 5% interest, and suddenly new bonds only pay 2%, your 5% bond just became really desirable. People will pay more for it, so the price goes up. In 2008, long-term Treasury bonds gained over 20%, while stocks were tanking. In the COVID crash of 2020, Treasury bonds surged as the Fed slashed rates. Now, here's the catch. Treasury bonds don't perform well in all market environments. If interest rates are rising and the economy's strong, bonds can actually lose value. But during recessions and market crashes, they're one of the safest places to park money. You can buy Treasury bonds directly through treasurydirect.gov, or, easier, buy them through ETFs like TLT for long-term bonds or IEF for intermediate term. I keep about 10 to 15% in longer-term treasuries as my recession hedge. When everything's falling apart, this position tends to rise. Number 5, utilities and infrastructure. And yes, this is another boring one. But again, boring is beautiful when markets are chaotic. Utilities are companies that provide essential services: electricity, water, natural gas. Infrastructure companies build and maintain roads, bridges, pipelines. The magic of these businesses? People can't really cut back on them. During a recession, you might cancel your Netflix subscription. You might stop eating out. You might delay buying a new car. But are you going to turn off your electricity? Stop using water? Obviously not. Utility stocks historically show lower volatility during market crashes. In 2008, while the S&P 500 dropped 37%, the utilities sector only dropped about 28%. Still not fun, but way better than most sectors. Plus, and this is huge, utilities typically pay solid dividends. Many have dividend yields of 3 to 4%, sometimes higher. So during a recession, you're getting two benefits: relative stability and cash flow. You're not going to get rich quick investing in utilities, but that's not the point. The point is to not get poor when everything else is crashing. You can buy utility stocks like Duke Energy, Southern Company, or NextEra Energy. Or grab a utilities ETF like VPU or XLU. I personally keep about 10% in utilities as part of my defensive core. It's my boring money that I don't worry about. Number 6. Healthcare and pharmaceutical stocks. And this one's pretty straightforward. People get sick during recessions. People need medicine during recessions. Healthcare spending doesn't disappear when the economy tanks. If anything, stress from financial hardship can increase health issues. Companies like Johnson & Johnson, Pfizer, United Health, these businesses have consistent demand regardless of economic conditions. You can't really delay critical medications or necessary medical procedures because the stock market's down. During the 2008 crisis, healthcare stocks significantly outperformed the broader market. The healthcare sector dropped only about 22% compared to the S&P's 37% crash. And many pharmaceutical companies barely dropped at all. Plus, here's something interesting. During economic downturns, governments often increase healthcare spending through stimulus programs, and big pharma companies tend to have strong cash reserves and pricing power. Now, not all healthcare stocks are created equal. Hospitals can struggle if people delay elective procedures, but pharmaceutical companies and health insurance providers, they tend to be rock solid. You can buy individual healthcare stocks or invest through healthcare ETFs like XLV or VHT. These give you diversified exposure to the entire sector. I keep about 10 to 12% in healthcare as part of my recession-proof allocation. It's defensive, it's essential, and it pays decent dividends. And finally, number 7, the most underrated recession asset, cash. Now, I know what you're thinking. Cash? Really? Cash loses value to inflation. Cash is trash. Cash is for people who don't know how to invest. And normally, you'd be right. Holding too much cash during good times is a mistake. It's losing purchasing power while stocks go up. But during a recession, cash is king. Here's why. When markets crash and everything's on sale, who can actually buy? The people with cash. While everyone else is forced to sell at losses or sit there paralyzed, the people with cash reserves are shopping. Warren Buffett famously keeps massive cash reserves. Why? So when opportunities appear, when great companies are selling at panic prices, he can strike. He made some of his best investments during the 2008 crash because he had the cash to deploy. Cash isn't really an investment during recessions, it's ammunition for opportunity. It's your war chest. It's what lets you be greedy when others are fearful. I'm not saying keep 50% in cash. That's too much. But having 10 to 15% in cash or cash equivalents, high-yield savings accounts, money market funds, short-term treasury bills, gives you options. When markets get volatile, I actually increase my cash position to 15 to 20%, not because I'm scared, but because I know opportunities are coming. And when quality stocks are down 30 to 40%, I want to be ready to buy. All right, so now you know the 7 investments. But here's the big question. How do you actually structure this? First, let me be clear. This is not an all-or-nothing strategy. You don't need to sell everything and go 100% defensive. That would be crazy. You'd miss the growth when markets recover. Here's what a recession-proof allocation might look like. A conservative approach, higher protection, would be 25% consumer staples and utilities, 20% dividend aristocrats, 15% treasury bonds, 10% healthcare, 10% gold/precious metals, 20% cash. A moderate approach, balanced, would be 15% consumer staples and utilities, 15% dividend aristocrats, 10% treasury bonds, 10% healthcare, 5 to 7% gold, 10 to 15% cash, 30 to 35% growth/other assets. The key insight here is this. Even if you only have 20 to 30% of your portfolio in these recession-proof assets, it completely changes your. You won't be down 50% when markets crash. You might only be down 15 to 20%, and you'll have cash to buy the dip. And here's the strategy. During good times, you gradually reduce these defensive positions and increase growth exposure. During uncertain times, or when valuations are high, you increase your recession-proof allocation. It's not about timing the market perfectly. It's about having a portfolio that can survive anything while giving you the ability to capitalize on opportunity. Now, before we wrap up, let me quickly cover the 4 biggest mistakes people make with recession-proof investing. Mistake number 1, waiting until the recession is officially declared. By the time the recession is official, markets have already crashed 20 to 30%. You're already too late. You build recession protection before you need it. Mistake number 2, going 100% defensive. This is the opposite problem. Some people get so scared they go all cash and bonds, and then they miss the entire recovery. Recessions are temporary. Growth returns. You need balance. Mistake number 3, panic selling your quality assets. Just because stocks are down doesn't mean you sell everything. If you own great companies in growing industries, hold them. Add to them. The worst thing you can do is lock in losses by selling at the bottom. Mistake number 4, not having cash ready. This is huge. If you're 100% invested when the crash happens, you can't take advantage of the sale. Keep dry powder. Keep cash reserves. Be ready to act when fear is highest. Avoid these 4 mistakes, and you're already ahead of 90% of investors. All right, so let's make this actionable. Here's exactly what you should do after watching this video. Step 1, audit your current portfolio. Pull up your accounts right now, your 401k, your brokerage, whatever you have. Calculate what percentage is in defensive assets versus growth/speculative assets. Just get a baseline. Step 2, calculate your recession-proof percentage. Based on your age, risk tolerance, and market conditions, decide what percentage should be in defensive positions. For most people, anywhere from 20 to 40% makes sense. Step 3, choose 2 to 3 investments from this list to research deeper. Don't try to implement everything at once. Pick the 2 or 3 that resonate most with you. Maybe it's dividend aristocrats and utilities. Maybe it's gold and treasury bonds. Start there. Step 4, set up automatic investing into defensive positions. If you're doing this right, you're building these positions gradually. Set up automatic purchases into a consumer staples ETF or a utilities fund. Make it systematic, not emotional. And listen, if you got value from this video, do me a favor, hit that subscribe button. Over the next few weeks, I'm going deep on each of these 7 investments individually. We're talking full breakdowns, which specific stocks to buy, how to analyze them, real portfolio examples, everything. And look, I'm not trying to scare you, but the reality is that economic cycles happen, recessions happen, market crashes happen. The question is, will you be ready? Most people lose money during recessions because they're not prepared. But you? After watching this video, you now know exactly how the wealthy protect and even grow their wealth during chaos. Because here's the truth that most people don't understand. Recessions don't destroy wealth, they transfer it. They transfer wealth from the unprepared to the prepared, from the panicked to the patient, from the emotional to the strategic. Make sure you're on the right side of that transfer. Thanks for watching. I'll see you in the next one.